unfortunately, you can't really get at that money until you're at silly retirement age of like 65 or whatever. If you play this game right, most people are able to be retired but in their 40s, and then you're sitting around waiting for that money to come out. The only thing that and then I know the elephant in the room is like the 10% penalty, but it's like, who cares? If you're able to make a lot better returns, you should be, that should be a wash in like a year or two.
Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join us as we explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe. Hey, today's guest is Lane Kawaoka, a professional engineer turned real estate investor who's helped over 1,000 investors climb the wealth elevator, from managing $2.1 billion in assets to returning over $45 million in distributions. Lane has built one of the most respected private real estate communities in the country. And in this conversation, we'll unpack how he went from engineer to empire builder and the frameworks that any analytical professional can use to accelerate their own path to passive income and freedom. Now, one of the cool things just behind the scenes that I wanted to share is that Lane is also from Hawaii. He resides there now. I grew up in Hawaii on the Big Island to the Hilo side. For those that know, I read his book a couple years ago. It was early 2023, before I even started the podcast that you're listening to right now, or maybe watching on YouTube. So it was really cool to have Lane on to read his first book, and then also prepare to think about what is it I want to ask him in this interview, in this podcast. And so I read that book, Wealth Elevator, as well. And one of the things I was super surprised about, and pleasantly surprised about, was how easy it was to understand the levels of the wealth elevators. He describes it. And the most important thing, the most important takeaway is to understand the levels there and to realize the path that is ahead of you, especially if you're maybe just getting started into real estate investing and maybe just getting started into the alternative investments, these private placements, the syndications, the funds, and get exposed to some of these other strategies like the tax things that we get in, and some of these other ideas that will help to strip back maybe some of the myths that we might hear about in the pop culture type of traditional investing advice. Now, we don't give investing advice, financial advice here. None of us are tax professionals, financial advisors, all that sort of thing. But it's really good to hear so that you get exposed to it and you can kind of look into some things for yourself. So that's what I recommend. Listen to the things that Lane talks about so that you can figure out what questions are best applied to you. I absolutely think the book is a great read. It's a short one, but it really lays out the path ahead of you and also helps you to think about things that you should avoid as well. So with that, as usual, please take notes and enjoy the episode. If you're so interested in this kind of stuff, definitely sign up for the newsletter as well, aritacapital.com, and you can go sign up for the newsletter. We have a ton of resources on there for you as well. Thanks so much. And if you have any questions, reach out. Please enjoy the episode. Mr. Lane Kawaoka, dude, I'm super stoked to have you on the show. I have read both of the books you have, your latest one, The Wealth Elevator, which I'm excited for us to get into. I was just telling you right before we started recording here as well, is that, 2 years ago, or right before I started my podcast 2 years ago, I was reading your first book. I think I was on my way from Austin, where I live today, back to Seattle and reading your book. I read the entire thing on the plane. It's like, dude, I got to get into more of this. So I got to start the podcast and just dive in with both feet. So it's really cool to have you here to share your knowledge, your wisdom with the audience. Your background is engineering. This is the path to passive real estate investing for tech professionals. So very much the same type of people, same type of audience. So thank you so much for being here.
Yeah, thanks for having me. Hopefully you got a movie in on that plane ride. The first book wasn't a very long book, right? It's just my story. It's not very long. So
yeah, but I mean, sometimes it's exactly what you need just to get the content. That's what I appreciated. So please introduce yourself, kind of the background that you tell your story, And then I really want the listeners to hear about the wealth elevator, talk about these different phases. And, it's just so appropriate to get these steps and milestones along the way. So please introduce yourself and we'll dive in.
Yeah, so I think similar background to a lot of people listening. We are brainwashed to go to school, study hard. I also went to University of Washington, but I wasn't as smart as a computer science engineer like a lot of y'all. I was a dumb civil engineer, industrial engineer, who barely got an engineering degree from the University of Washington, so I could cheer for the football team. But I went to work, and again, like we're all brainwashed to like do the 401k and then buy a house to live in Seattle. So that's what I did. And because I was lucky enough to do this in my early 20s, I didn't have a wife or kids to take me off of my goals of financial independence. So
Mm-hmm.
I lived there, but I was only there on the weekends. So I didn't have the opportunity to go to Belltown on the weekends, go drinking with my friends. I was out on the road all the time, and I was only home on like Saturday. So back then it was like, this is kind of dumb. And this is well before like the days of Turo.
Yeah.
So I just started to rent out my house, and I was like, whoa, this is cool. At that time, I didn't know anything about the rent to value ratios or the 50% rule and expenses. I just knew that I was making like a few $100 of beer money every single month. And that was really cool to a young 20-year-old. I later
Sure.
bought a duplex in a less desirable area in South Seattle. And then as prices came up, that was around 2012. And around by the time 2015 came around, I went out of state, started to buy a bunch of turnkeys, and I had 11 of those things in Birmingham, Atlanta, Indianapolis by 2015.
Nice. Awesome. You were talking about getting those turnkey. How did you find those? I mean, was it just networking groups and someone said, hey, look at buying things out of state?
Yeah, but at that time, like there weren't that many podcasts back then. So these turnkey providers would advertise on those podcasts, and they'd say, oh, invest in Memphis. I think now the only thing that works is garbage in Baltimore, which I would never invest in. But like you kind of follow the breadcrumbs, right? And I knew you overpay. Like some of those turnkey companies back then, like they were overcharging people by 20 grand. So what I would do is I would kind of use that as a blueprint. Okay, they're buying in these types of locations, this is what it looks like, right? Like 1,100 square feet, 2 bedrooms or 3 bedrooms, 2 baths in this area. And then some of those guys would have internal property management firms, which I don't think is the way to go, or they would outsource to third party property management. And
Mm-hmm.
to me, I think that's the key when you're a property management or you're looking for your team is the property management. The brokers, the lending brokers, they're just trying to get you to buy. They're not your friends, guys. They're just
Yep.
trying to get you to buy. And then as soon as you close on that asset, they peace out. They're gone. You never see them again. But it's that property manager who is really your kind of unofficial partner in this that's going to give you the real scoops on the property. So that's initially how I started. I think I maybe bought one of those or two of those turnkeys through those turnkey provider marketers. I mean, they're all marketers, not the actual people doing the work.
Yep.
But that was how I started, and then it got me to the property management teams, and that was kind of where I went running from there.
Yeah, kind of getting critical mass, for that you can manage with those property management partners, but then getting your, I wouldn't say kind of both feed in. You're learning, jumping into these different masterminds, jumping into the groups. I know kind of a dirty word. It's not, masterminds. It's not super relatable to a lot of people who aren't getting into these groups, but nonetheless, right? This is where you started to see levels to the game. Can you walk us through like?
Yeah, you start to realize that you need to kind of hang out with the people that are in your caliber. Unfortunately, like the local real estate club is a bunch of guys who don't have very much money nor make over $50,000 a year at their day job. So they're working with a different set of tool sets there, or lack thereof. And everybody talks about networking is important, and it is, but unfortunately when you're on the bottom rungs or kind of dumpster diving through those types of organizations, everybody's out to kind of get theirs and start, which I get it, right? But um, that's unfortunately where it's kind of a two-sided. It's a paradigm shift, right? When you get to be more of an accredited investor, interacting with other high net worth people becomes so much more important and valuable because there's gold in there, and people actually want and want to help each other out, or realize they need to help each other out to get to where they're going. Whereas when you're, just a regular real estate club, low barrier to entry, it is kind of, it's, you're going to just going to go through some brain damage doing that.
Yeah, it's a lot of the same conversations too, and like you're talking about, people, if you're making multiple six figures for the year, you're also probably already thinking about your time is a lot more valuable anyway, because you're probably, chances are, you're doing 50, 60, 70 hours too, right? So it pays to get into certain rooms. What
Yeah, you got to pay to play, unfortunately.
As you went through learning more and more, you ended up putting together the wealth elevator. Talk a little bit about that, because I want to highlight why this, spend a lot of time here and going through some of these, some of the levels, but also some of the mindset shifts, because I think that's a huge unlock. One of those, and before you get into it, one of those is definitely that I've heard you talk about how it's probably not a good idea for for people that are accredited investors who are making multiple six figures to go and get a single rental property, right?
Yeah, so like I kind of touched upon it just a little while ago, right? Like there's this concept of there's paradigms in the world. Kind of using a different example, because I'm just thinking about the other day. Like, I mean, watching baseball. My Dodgers won, or my Shohei Dodgers won, apparently. But I didn't even make my high school team, right? I mean, I know how to catch the ball and throw it. I know how the strategies, but like I suck at it, right? Like there's different there's different tactics that I would do if I went and played softball with my buddies now, right? In the 40 and over softball league. I'm not very good. I kind of know what I'm doing. I'm not terrible.
Mm-hmm.
Um, and so it's like there's multiple paradigms, or in my book, The Wealth Elevator, there's multiple floors to this wealth building game. Talking more about finances, there's a lot of people that go to the real estate clubs that don't have very much money, that make under $50,000 a year at their jobs. And that's what we would categorize as on the basement level of the wealth elevator. A lot of these guys just need to work on basic finances and budgets. It's probably not the people listening to this podcast today. You are either on the first floor or the second floor of the wealth elevator. The first floor of the wealth elevator, non-accredited investors between $0 and $1 million net worth. You may have a decent salary, but you certainly don't make multiple six figures at your job. Again, there, I think it makes sense to go buy your own little rental properties. The guys who are higher, as I did, maybe when did I cross over that point? Maybe 2017, 18, somewhere in there. I think, or if you are so lucky to be a doctor or a dentist making multiple six figures and already an accredited investor, then it makes sense to go to different syndicated deals and get out of the direct ownership of rental properties for the liability reasons, right? And just the headaches. It's not worth the squeeze. Specifically speaking, whoop-de-doo if you invest $25,000 on a down payment and you get $300, $200 a month. Whoop-de-doo. That ain't changing your life for that much amount of brain damage and legal liability. So as I kind of just went over, there's like the basement level, first floor, third floor, or second floor. It goes through different paradigms right there. Like that's things that Shohei and Yamamoto are talking about throwing the baseball are different than the stuff that the person who went to high school or college are talking about, and different than average Joes like me, right? I'm not terrible though. I'm not in the basement, but and that's that, to use that framework. I never saw a book out there, anybody talk about this idea of like there's more than 3 or 4 different floors of the wealth elevator, let alone 1 or 2. Right.
Mm-hmm.
The best thing we had was that silly Rich Dad Poor Dad book that just kind of told us to go buy assets and
Right.
said the government was, horrible. Right.
Yeah.
I mean, it says a lot in many, many words, says a very little in many, many words at the end of the day. But that was, I think this book, I think, is made for people around the credit investor status. They're going to get there quickly. Of course, everything that I talk about in the book is experience shares. I don't really teach or talk about anything I haven't done myself. So we get into what comes after 2.5 million, what happens
Hmm.
after 4.5 million. That's a critical range, in my opinion, because most of the investors are above 2.5 mil, and they are getting to a point where they have excess, so they want to do more with it. So in reality, they're actually getting a little bit more aggressive,
Excess
especially if
cash
they have
flow.
never been in just net worth, right? These are categorized as the guys in their 50s who did maxed it out the 401k for a decade plus, doing
Hmm.
it the wrong way. And they kind of realize that they, maybe they could be doing something else, right? Because they have a little bit more, length on the leash to play around with. Where when you're younger, that's when you need to be more aggressive. But admittedly, or like, I guess empathetically, that's when you are least likely to take a swing at the game, right? Or
Why do you
swing at the
think?
bat for a home
Why do
run.
you think that is?
Because I mean, to put it simply, you're just less economically resilient, right? You losing 50 grand on your investment is going to be absolutely devastating, right? Like that, like there were times in my life, in when I was in my 20s, that it took me $30,000 to save just in 1 year. That's
Hmm.
like over 1 year of lifeblood doing out in the field work and late nights, and like, whereas when you're older, you should have some other assets. They may not be alternative assets producing good yields, but you should have enough assets where, a lot of accredited investors are able to save 100, $200,000 a year. That $50,000 loss is going to hurt a lot less.
Got
Not
it.
to
So you
say
mean,
that it's, not to downplay it, but yeah.
yeah. So you mean it from the perspective that when you're younger, you'll have less assets in general. You're likely to, if you have done the prudent thing to save, invest some things, have that grow, you'll have less of it when you're younger versus if you have invested that over time and you will have a bigger portfolio. That's how you mean that.
Yeah, I mean, another example, if I just sent you out in Las Vegas for the night with $1,000, I mean, you kind of be pinching your pennies. But if I
Sure.
gave you 200 G's, you'd be a little bit more liberal with it. Another example is, and I hate this example because I try not to repeat anything that is uh, said in the traditional investment space. But they say when you're younger, you need to do those index funds where it's more stocks to bonds, because when you're younger, you should be more aggressive because you have more time. And you know what? They are right on that one, right? You should be more aggressive when you're younger. But again, I think of it as a different paradigm. Again, I'm not giving any financial advice because I'm not a certified financial planner. What do they know? But to me, I think there's a bit of a paradigm. If I were the way I played it, when you're younger, under a few million net worth, I think that's when you roll the dice a little bit. Um, when
So
once you're in that $2 to $5 million range, that's when you might be a little bit more conservative. That's when you're kind of finishing things off. But we have some people that are in that 5-10 million plus range. A lot of these guys are business owners too. I mean, that's really how you get to that point. You don't get it by being a W-2 employee, but they get to that point where they're like, well, all this is gravy. I'm totally fine with 4 million net worth. This is all house money. Let's just shoot to the moon with this stuff. So, there's a kind of a triple point effect here.
got it. Yeah, that does make sense. So, kind of the is basement's not even, we're not considering this even a floor, right? We have basement and then first
Yeah, it
floor.
doesn't even get a number. It's not even a number. It's floor is zero, right? Yeah.
Got it. So
Yeah. I
it's
mean, that's
really,
that's what there's all these books for, like Dave Ramsey, Caesar Orman, right? Like great books, but different advice in those books than what accredited investors should follow.
and so we're saying really at the first floor is that, I forget the exact numbers, but this is when people are first getting used to understanding about syndications, and I think funds is where you introduce funds at this level as well.
Well, yeah, I guess I mean that usually coincides, right? But you can be on the fifth floor of the wealth elevator and be a complete moron with investing too. You can be a very sophisticated investor and with $250,000 net worth. Um, typically what you're saying is true, but I would just categorize people on different floors of the wealth elevator based on not what's in their head, but what's in their wallet and what's coming in on their paycheck.
Sure. The reason why I was just trying to align on that, on the the earlier stages part, is because what you were talking about with the people that are early on should be a little bit more aggressive, and so since we're talking about this from a perspective of really kind of syndications or funds, then what does that even look like, right? To that's my question. What does being more aggressive with syndications or funds look like? What should because that's the majority of the people listening right now.
Yeah, I mean, if you want to dive into the topic, there is a bit of contradiction here. Most investors, or what I like to do, is I like to invest in individual deals because I can underwrite it, I can see it, I can touch it. And that's kind of the reason why I like this type of investing, because you can insider trading, right? Like if you buy that apartment there, you know what kind of the dynamics are on that asset. Now, funds have a bunch of assets, and a lot of times you don't know about it. They're blind pool funds, but even if you knew what the assets were, they're kind of diversified and pooled. So in theory, those are a little bit the fund investing through funds, private funds, not REITs. REITs are institutional products with a lot of high fee bloat in it. I'm talking private funds, direct to the source. When you're in that, you've got a little bit more diversification. It's a little bit, should be a little bit safer, but less upside returns. The way I think about it is, if you're a whiskey drinker, you've got your single malts, single barrels. Typically, those will fetch the higher costs, right? Because it's rare. Where you've got the blended model, which is like your funds. Those are a
Mm-hmm.
lot very much more consistent, more smoother. But you don't fetch $1,000 plus price per bottle on those things. Best thing there is like Johnny Walker Blue. It's the same damn thing every single time. It's consistent, but it's not that high price. Now, most investors getting into this space, under $5 million, will typically want to pick and choose because they have a sense of pride in what they own, along with 200 other people, right? It's kind of
Right.
silly, but they will go into the single malt scotch or the single asset. To me, that is a little bit more risky. And then when I say risky, I mean the good side of risky too. More risk typically comes with a little bit more return too, typically. Whereas, but here's the problem: when you're first starting out, you don't know much. You don't have a network of other accredited investors. You don't know how to underwrite. Most LPs don't have a clue how to do that stuff.
Mm-hmm.
So with that respect, you should go in with the fund that's a little bit more safer,
Right.
right? So there's a little bit of a contradiction in this whole thing. What people do isn't necessarily what you should do, but hey, it happens anyway. It's kind of one of those things.
Do you think that that's where the doing the due diligence, finding good sponsors is really where that comes in? Because the range at which that dichotomy we're really kind of kicking around here is knowing enough to understand kind of like the business models and what makes sense. Maybe not knowing all of the line items to underwrite something as an absolute pro, but understanding the model, understanding what the returns look like, that kind of thing, and then going to do the due diligence on the operator because they're really the specialists here. Like, do they have the track record, and have other people also had got good results working with that person?
Yeah, so you're right there. The cons or the dark side of that argument is in the private investment world, you can't really verify track record, right? Like it's all private world. People can just put whatever they want on their pitch deck and say that they were that successful. What I'll do is like when we are looking at a deal, we have access to insider information, such as like Yardi reports, what the we have connections with other loan brokers, and we can kind of ask around on how their other assets are operating. So that, I think, not perfect, but that's a heck of a lot better than asking what some other LP, what do they know about somebody, right? Like,
Sure.
um, but then now you expose yourself to the whole, like, well, now that operator was just doing a big Ponzi scheme with all their assets and we're lying about it, and then you go down with it too, and it kind of brings up another discussion of diversifying with different operators too, because I've seen it, like when somebody goes through, whether they say booze, women, and drugs, and like,
Sure.
man, it all comes down, right? And then it doesn't matter if you are invested in five of their deals and they so-called paid the most sponsorship fee to get put up on the platinum sponsor list. All their deals are going down. So I think that's, you are right, but there are other sides of it. To me, what I do is, like, I take all that stuff out, right? Like, I'm gonna look at the deal first and compare the deals out there. Then I'm gonna go and look at the person next, right? That said, I kind of cheat a little bit. I know the people already. I'm not gonna look at their deal if I know that they're untrustworthy, or just I know how their other assets are working. But that's the order operations that I'll go by. But like, to your point, the LPs don't have that accessibility, and they're just, it's kind of like the blind leading the blind in a
So
way.
what's the recommendation
Um,
here then, right? Because we're, the macro of the conversation is that people are listening. They're not at the basement. They're accredited investors. People listening are somewhere between, honestly, 250 to 500K, annually, right? Somewhere between two to 500. And so, they're based on what I kind of looking at the framework that puts them somewhere on net worth right around the second floor, I think 500 to like 2.5. And so if they've maybe got their own residence, right? They bought their own house, they're in there, and the kind of the messages, don't go and buy the single family rental, look at private placements, look at a syndication or something like a fund, especially because the single malt versus the blended, that's a fun analogy. But do you have a piece of guidance that they should that majority listener can take away before we move on to kind of mapping out the rest of the levels too?
yeah, I mean, it's unfortunately like a chicken and egg thing, right? I do think you have to meet other purely passive accredited investors that have been in a lot of deals, but I think the question is, where the heck do I start
Yeah.
first, right? Like, to me, like, going back to my other analogy of playing baseball, right? If Shohei and the guys asked me to play in their celebrity softball team, I suck, right? So like, there are certain things I'm going to do to cheat to get the most amount of my talent, right? Kind of the same thing here. To me, if you're brand new to this, I would start by learning the fundamentals, or learning the definitions first. So I think part of it is just to keep diving in, and every word or definition that you are not familiar with, get pretty familiar with and start to learn the vernacular. I actually did this with like salsa dancing, right? You learn like the moves, like what they're called first, or what
Yeah.
the heck it is. Then you piece them together later. I would say, as far as like underwriting numbers, like there are a lot of different things you can look at. I'm a big 80/20 guy, especially for in this discussion here. To me, the the few things that move the needle the most on the underwriting spreadsheet that a lot of the sponsors will fudge their numbers on is a reversion cap rate, what the rent increases a year are, what the percentage escalators are. That ranges anywhere from 1% to 6%, and the what is the occupancy assumed at, right? They better not be assuming it's at 95%.
Right.
92% is a little bit more reasonable. But these are the things that, when as an investor, you're flying through that PDF marketing sheet, and you're trying to spot check their assumptions. This is what we do, and we would get a deal, we underwrite it ourselves. We try not to look at the answers, right? Because that'll that just makes it make us biased, right?
Yeah,
We'll
exactly.
underwrite it ourselves, and then we'll kind of normalize the numbers, because they might have come up with doubling our money in 5 years, which is 100%. And when I apply, 1.5% to rent increases, a reversion cap rate that's slightly higher to exit at, I might have that deal might be penciling in at 30% return in 5 years, which is abysmal. And so I think that's understanding what those first one thing, like reversion cap rate, like understand what that concept is. So when you look at a deal, you're able to piece it together and then kind of move from there. Ultimately, it's about taking a lot of pitches and just constantly doing this again and iterating. But unfortunately, a lot of people on these like LP forums are just they don't understand this stuff, and I don't know what the hell they're looking at, and they just go off of whoever the one or two outspoken people are. You guys know who I'm talking about, right? The Dunning-Kruger effect at play here,
Sure.
where they don't know what they're talking about, and sometimes I'll see things that they're saying, I'm like, you know what, that makes a lot of sense, but it is completely wrong. If you're a real estate operator, like, that is completely wrong, but it makes a lot of sense. So it fools all the other doctors, oh sorry I said it, but other on the people on there into like thinking this way, where I'm like, well, you gotta at least be able to like learn some of the basics here,
Got
I
it.
think.
So, as usual, education first, right? Got to know what we're looking at. Of course, like you're talking about with the different terms. And of course, talk to people as you learn things as well. Learn how to, I mean, the tech professionals, tech people listening, you better know how to operate an Excel sheet and some analyzer. You better know how to use AI to like get some answers, right? Um,
Yeah,
uh,
that's a good starting point now, right? Like at one time, I thought, I mean, the problem with AI is it confirms your biases. And I've done it. I've thrown a pitch deck and P&Ls and rent rolls into an AI and just say, is this a good deal to invest in, right? It just tells
well, got to ask
most
better
of the stuff is
questions, but
pretty
yeah,
good. Most of the stuff is pretty good, but maybe 20% of it or more is just totally off base. And like, dude, what are you thinking of? Oh, sorry, you're right. It does one of those things. And so if you don't know some of the basics, you're going to get totally duped into thinking the wrong thing on something critical and obvious to some people. But then again, it's a start, right? Like, I mean, I was dumb enough to go through all these like guru classes where I paid like 30 grand, 50 grand for, and I don't know if that was worth it. But
same.
with AI, I think it's good bang for the buck, I guess.
Yeah, it's I agree with what you're saying on the AI piece if you're not using it effectively, and I say using it effectively where it's like, hopefully many people listening would know about like making sure it's a certain role, adding certain knowledge bases, and using a little bit more like a power user versus just asking surface level types of questions to it. But nonetheless, I think the point is educating yourself and using some tools so that when it does spit something back out, you can eyeball it and be like, I don't know about that, right? um,
Yeah, yeah.
but
The
so
dangerous thing in the beginning is like, how do you get to that point, right? Like that's what I'm fearful. Like my daughter going to her first party. Oh, geez, you don't even know what you're doing. Like it's kind of dangerous in a way.
that is a whole other can of worms, Lane. Good luck on
Yeah,
that.
different set of worms, but um,
so
yeah, it's kind of
so
similar, right? Like,
yeah, definitely. I don't have kids yet, but I have no idea what the world's going to look like when I get there. So I'll be calling you for that one.
yeah, well, they'll have sticks to stick in their drinks. I didn't know this, but apparently they all have their Yetis, and that way their drinks are covered all the time. For those types of things. But
Smart.
they'll all have like party Apple AirTags by that time. It'll be completely safe, right? Don't worry,
That's
the government will
funny.
protect us all, right?
Yes, the government will
Yeah,
provide.
or the tech, you guys in the tech world will figure it out and protect us
Dude, we're on it, man.
on it.
so so Basement, first floor. First floor is getting your stuff together. It's like 50,000 to 500K net worth. Same kind of thing. You know, you should be educating yourself every level along the way. But really, you know, since we're talking about there's different parts of the wealth elevator here. We have net worth, monthly cash flow, really kind of how we're looking at doing a portfolio breakdown. But you know, really first floor, second floor is making sure we know what we're looking at, what we're investing in, right? Syndications, the funds, the asset class, like the 92% occupancy, these kinds of things. You're talking about multifamily. I know that's like your background is your expertise there. So just to call that out. But whatever the assets that someone is looking at for those deals, it could be self-storage, it could be whatever else, as an example, right? But what are so in this case, just kind of moving along with this, right? Because I really want to hear the thoughts of moving through these different levels. Is so talk to me a little more like what is someone how does what does it look like for someone to go from like level 2 to like level 3, right? From have they invested in I guess maybe the number of investments doesn't really matter. I mean, there would be some correlation to how much they've invested in versus really how much net worth they've grown, right? And how much cash flow. But I'm trying to look for what are some of the mindset shifts that they're going to have to make? Like, what are some of the problems? What are things they're going to have to get through?
Yeah, I do think it is kind of the mindset shift, which stems from net worth, but it ultimately comes from there comes a certain point, and it's different for everybody when you are literally financially independent, right? When your assets produce enough income for you where you don't have to work. So for most people, that's around $4 million net worth. Some people who are in cheaper places to live, or maybe their kids are out of college already working, not a financial liability to them. It might be even be $2 million net worth, right?
Mm-hmm.
And you're on the third floor of the wealth elevator. But it's a point where you don't need to trade time for more money. You're just good what you got, and of course you're going to keep investing, and it will continue to grow. But if you wanted to, you could just put it in T bills and chill or life insurance at that point and be totally fine. So typically, people get to a point. I mean, I don't know. I don't want to say typically because I see all kinds of people these days, right? Like there's at least 9 different profiles when people come in. It's kind of easy for me to kind of categorize everybody, but it's more, yeah, it is that mindset thing. You are financially independent at that point, or you should be, right?
Okay, so what are I mean, T bills and chill. I'm going to take that one. That's a fun one. I appreciate that. What are so great. So they're financially independent, meaning that, like you said, their assets, the cash flow is covering their living expense, right? Financially independent, right?
Yeah, or not
So
necessarily like already, but the potential energy is there. The rocket is rolled up to the top of the hill. For example, a guy who has $5 million in assets in the 401k stuff, not producing any cash flow, right? Because that stuff sucks. But if he wanted
yep,
to, you could just withdraw it all and put it into T bills or
sure.
I savings bonds if he wanted to, right? And that would produce, what would that produce? Like $200,000 or $300,000 of income every single year, right? Like he's oh, by the way, he's super cheap and a miser. That's why he grew all that money anyway, in those types of investments, which is what you see a lot of people, which is a little sad, right? Like they get to that point by just being a miser and saving, delayed gratification, and they have way more amount of money than they need. And this is a kind of concept that I see, especially in my mastermind group. I always joke, it's like, man, you guys ran 35 miles in a 27-mile long marathon. What the heck is wrong with you? Like, hey, we're done. Like, relax. But
Yeah.
it's I would say it's more net worth thing then. Yeah,
Okay, so were you talking about the money saved was in savings or was in one of the retirement plans?
it doesn't matter. I mean, net worth is net worth. I'm sure. Yeah, maybe you discount the retirement funds because you got to withdraw it, pay 10 to 40% in taxes, but essentially net worth,
Yeah, I
deployable
I
funds.
right, the wherever the the capital is, right? But the reason why I was clarifying, just because you make a really good point, and I wanted to get your to expand on that part of, if someone does have a bunch of money stored in their 401k, right? I uh, do you suggest,
But
and
we don't want
let's
to
say
tell
they're,
them because they'll be so upset that they did it the wrong way for so long. We don't want to tell them.
but we got
But
to
like,
talk
I mean,
about this.
that's the big dupe. That's the problem with all these 401ks, right? Or these self-directed IRAs, is that the sell is, hey, you can defer your taxes all the way to the end. Unfortunately, like it's probably I mean, it depends on everybody, right? I'm not giving any financial advice here because it's all
Same,
personal.
same.
But but for a lot of people, they're going to be making less money earlier on in their career. So they're probably going to be in the lower tax brackets. As they become more senior, they get paid more. So typically ascend into those higher tax brackets. So a lot of those people are at that point trying to get money out of their retirement are going to be in those higher tax brackets. Now, for most people out there, like in the basement, when they quit their job, their income will go down. And yeah, that's somewhat true, right? They maybe go back to the lower tax brackets, but people like us, I know we sometimes come across as elitist, but it's like, no, we plan to make a lot more money when we quit, right? Because we
Yeah,
have all this investments that produce cash flow. So you're either going to be staying in the same tax bracket or higher, right? So that kind of argument gets taken away. That's the first thing. The second thing, government entitlement programs, like taxes are going to go up. The tax bracket's going to go up, I think.
right.
That's my
Yeah,
hunch. We don't know that, but I'm willing to bet that way. So the idea is pay your taxes now as opposed to the future. Essentially, the government has a free blank check for them to do whatever they want with your money that you socked away, that you got sold on their lies. Well, I mean, I don't know that for a fact, but again, this is all a gamble. We don't know, right? This is like investing. You don't know which way to play this. The other things are, unfortunately, you can't really get out that money until you're at silly retirement age of like
right.
65 or whatever. If you play this game right, most people are able to be retired but in their 40s, and then you're sitting around waiting for that money to come out.
Exactly.
um, the only thing that, like, and then I know the elephant in the room is like the 10% penalty, but it's like, who cares? If you're able to make a lot better returns, you should be, that should be a wash in like a year or two.
Yeah, it's such a it's such an interesting thing. So, for anyone who didn't catch all of the details there, we're not giving financial advice. We're not even, it is all subjective. Go look at your own stuff. But, the model being, we're looking at some of the federal sponsored type of retirement accounts. And Lane's talking about, the penalties that might come with early withdrawal versus the 59 and a half or 65, whatever the age is now. I don't remember. But if you're taking that money, getting it now and putting into some of these investments, then that money is going to be better off in something else, provided you've gone through it on the looking at the deal makes sense and all that kind of stuff.
Yeah, but
So
there's more. There's one last one. I think for me, the big difference maker is when I invest funds outside my retirement program, I get to take those passive losses, the bonus depreciation, to benefit my taxes today. So I save money on taxes today. When you're investing, I mean, you could invest to a self-directed IRA or solo for 1K, but if you invest 100 grand in a deal and you get $60,000 of passive losses from that deal, it stays insulated in that retirement. It doesn't come to you personally. So that's a big difference maker that most people, the lay people out there, don't have a clue on how that stuff works, right? But I think the big thing here is, like, I mean, if you stop and think about it, it makes a lot of sense. Not rocket science, and you're kind of like, that's interesting. At least it pushes you to more think for yourself and neutrality. But
yep.
most people aren't going to do anything that we're talking about unless they meet other purely passive accredited investors out here and kind of soundly verify on a sounding board with other people that don't have a dog in the fight.
Yeah. So we have a level left let's not dive into that at this very moment. I think that going through, the book and just getting some of these details and how they stack on each other is actually fantastic reading. It's a short read. I did it in like 4 days, but it's well worth it. But like you were talking about, being in the room in a group where there are other limited partners, other LPs, other passive investors. Talk to me about some of those, when you're talking to people, these 9 different personas, right? That these experience that you've had. What are some of the myths, some of the aha moments that you see from people, that they might get when they come talk to you about investing for the first time or second time for that matter?
I mean, I think when a lot of people come, they are like, oh, multifamily apartments make a lot of sense. Workforce housing, the rich are getting richer, the poor are getting poorer. This, makes a lot of sense to invest in the middle. It's a growing demand, population is growing. Like it makes so much sense, right? Let me plot all my money into it, right? Like, I mean, that's what I did. It helped me, and then it also hurt me several years back when there was a market correction.
Mm,
So and then whatever group you in, you get a little bit of group think mentality, and everybody's overzealous, whether that's mobile home park, self storage, apartments. But I think where I'm kind of getting to as an investor is a little bit more of a diversified approach with private equity, buying businesses in there, private credit, even venture capital, right? High asymmetric plays that you're probably going to lose your money on, but you're trying to get it diversify your portfolio so it's not um, you know all contingent on one thing. Which, by the way, the stock market is all contingent on pretty much Nvidia, right? Like that's pretty much most of S&P. So it's all connected, right? So you're trying to build a portfolio that's a little bit more resilient. It can go for higher returns, that's for sure, but it's a little more resilient. And the way that I see other peers doing that, and because this is where I learn from other people, right, that are smarter than I am. But these aren't the financial planners out there hawking, the financial products out there. These are the guys building their own portfolios on their own alternative investment portfolios, and of course they've coupled that with traditional holdings too. But for the guy with 10%, 80% alternative investments, man, their asset allocation mixes run the gamut, and you can't even begin to model out what's the average, right? Like there is no 60-40 stocks mutual fund kind of mix like in alternative investment world. You just have to kind of go with your gut. And but then again, like if you have less than 20% alternative investments in your portfolio, you're still just starting out,
yeah.
I think. So you just naturally have to learn more and more and more and get around more and more people.
Do you have any ahas that you can think of for yourself? Like, you started in real estate, single family, doing the syndications to learning all these things that we've kind of talked about in the wealth elevator, from syndications to funds to, pulling out money to insurance stuff, infinite banking and so forth. But, what was an aha for you of rounding out the asset allocation for you? To like you're talking about real estate, venture
Yeah, I
capital,
mean, like
private
take
credit.
2021 for you, right? Rents were skyrocketing. It seemed like a no-brainer. The banks were lending on this stuff because it was a very resilient asset class. But now looking back, those are the signs of an overheated asset class. And I think that's what investing is. Investing is about going against your human emotion, right? When things are euphoric and it seems too easy, that's when typically the end of the musical chair game is coming. And to be aware of that and to make the right moves and rebalance. Like I mean, again, we don't know, right? There's always black swan events, but stock market has been at all time highs. It makes kind of doesn't make any sense. Like that's when, if you really believe it, put your money where your mouth is and move your money and rebalance based off what you think you should have. Um, and when things are the most fearful, right, like prices tumble, that's when you should enter. So it's like, yeah, you invest off good fundamentals and things that have good demand in it, but you also have to keep in mind that, like, what is overpriced, what is beat up now, and be a contrarian investor in that facet. And then also know that you're out of control in terms of macroeconomics. Things could happen that could, interest rates shoot up, that just bombs everything in real estate right there. So I think that's kind of my aha moment, that I need to be a little bit more diversified. And yeah, but hey, that's part of the game, right? If it weren't fun, I wouldn't be doing it.
Yeah. It sounds like one of the things that I'm hearing too is you've become a much more seasoned investor and looking at the macro a whole lot more, looking at the economics, right? Versus just knowing a single asset class or just kind of looking at businesses, but seeing how they all work together in an entire economy, whether that's more local or whether that's much more macro.
I mean, my lame piece of advice is like, I kind of go back to the dollar cost averaging thing. And I hate saying things that the financial planners say, right? But they're kind of right on this one. Like you never know when multifamily real estate is going to be at its high, which is 2022. And you don't never know when the bottom is, which maybe we've confirmed the bottom as of last quarter, right? You never know these things. If you think you're one of those people who thinks they're better than themselves, or imposter. I don't know. You're not an imposter syndrome because you're an imposter. You just never know these things. So the way I look at it is like, I'm just going to dollar cost average, keep going, finding the right deals. Now, the right deals with the right macroeconomic tailwinds behind it, of course. Yes. But in those, so I'm going to identify what the piles of hay I need to invest in. Right. And the pile of hay is like, there's a lot of piece strands and needles in that pile. Yeah. There's a big pile for apartments. There's a big pile for mobile home parks. There's a big pile for AI startups. Right. And then I'm going to identify which pile do I like, certain ones I don't like. Office, I'll stay away from that pile. I'm not going in that pile. But like multifamily, workforce housing, I still like it. Right. So I'm going to look through that pile for the right needle, underwrite every deal that comes up, and then just pick the best one, and then keep diversifying, whether that's going into a deal every quarter, or maybe you don't have that much money, maybe once a year. Yeah. But like pick the piles and pick the best needle at the time, and just keep doing that consistently. And you may get really unlucky and there might be a correction next year. I don't think that there's going to be one in multifamily because we just had it, but take all that out of the equation and just kind of keep doing the right things, right? Just keep showing up, and just keep showing up to work, swinging the bat, with the same outlook.
Outstanding. It is time in the market, not timing the market. Mr. Lane Kawaoka, thank you so much for being here. Where can people find the book, and where can people connect with you?
Yeah, they can go to Amazon,
of course,
the Wealth Elevator. If you guys buy the book and you leave a nice review, email it to us, team@thewealthelevator.com. We'll hook you up with the PDF and the MP3. And then if you're a credit investor, my email is lane@thewealthelevator.com.
Awesome, dude. Appreciate you. Thank you so much. Go get the book. It is a fantastic read. I have gone through so many of these books, from the single family to like many of the different asset classes and so forth, and just seeing how simple the levels are broken down is really refreshing, because it's just straightforward, and instead of spending all this time to read a whole bunch of books and piece this whole thing together, I'm really obsessed about like customer journeys and figuring out those next steps. It's just really outlined pretty nice. Lane, thank you so much, sir.
Cool. Thanks, Steven.
Aloha. Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.